Chapter 9: How HeyMax raises its next round. This was one of the 3 questions I was asked to answer, so let me be direct about it. My first recommendation is, don't raise in 2026. Here's the reasoning. They closed $11 million in January. On my estimate, they have about $9.5 million left. They're roughly cash flow neutral. On a pure cash basis, they have 3 years of runway. If they went out to market right now, they'd be selling a story with 3 uncomfortable facts in it. User growth decelerated from 140% to 25%. Transfer partner count went backwards from 30+ down to about 20 against a stated target of 50. And the revenue figure, $6 million, 5 times year-on-year, appeared word for word in both the May 2025 metrics release and the January 2026 funding announcement. 8 months apart, identical. Now I actually think that's a stale figure being reused rather than genuinely flat revenue, because a company growing users 25% and merchants 60% in the same window is unlikely to be flat. But whichever it is, it's HeyMax's own ambiguity, and it will absolutely get probed in diligence. So raise in the 2nd or 3rd quarter of 2027. Open the process around April. Go out on audited 2026 numbers plus first half 2027 momentum, with 18 months of deliberate metric construction in between. The target, $25 to $35 million, at a post-money valuation of $140 to $200 million. Who leads it? A growth fund with either a loyalty infrastructure thesis or a travel distribution thesis. General Catalyst is the obvious name because they led, built, and already have conviction in this exact category. Insight or Bessemer if you want infrastructure multiples. GIC or Temasek if you want Singapore native patient capital, though note Temasek already backs Shopback, which cuts both ways. Regionally, Jungle Ventures, Vertex Growth, B Capital. And here's a recommendation I'd make strongly. Bring an airline or an airline group onto the cap table as a strategic co-investor. It converts the single largest supply-side risk in the business, the cost of and access to redemption, into an aligned relationship. And it's the strongest possible signal to every other airline in the pipeline. Now the metrics that have to be true by the 1st quarter of 2027. There are 12 in my full analysis. Let me give you the 6 that matter most. Annual recurring revenue above $20 million. B2B at 40% or more of revenue. That's the single most important one, and I'll explain why in a moment. Revenue outside Singapore above 20%. To prove the expansion thesis is real and not a slide. At least one named Tier 1 bank or telco issuing max miles. They don't have one. SingSaver is a comparison site. Chocolate Finance is a fintech. Neither is a marquee logo. 35 or more redemption partners. The majority contracted directly rather than through a sender. And a published, audited miles liability model with a stated breakage assumption. That last one deserves emphasis because it's counterintuitive. Most founders would want to keep that number quiet. I think exactly the opposite. A company that walks into a diligence process with its own liability model, its own redemption curve, and a defensible breakage assumption looks like an asterisk program operator. A company that has one produced for it by an investor's accountants looks like a startup that didn't know what business it was in. Now let me talk about the narrative, because I think this is worth $80 to $120 million of valuation, and it costs nothing but discipline. What HeyMax says today is, roughly, AI-powered loyalty and travel rewards platform, 150,000 users, 800 merchants, 500 million miles, expanding across Asia-Pacific. That is a asterisk consumer app asterisk story. Consumer apps price at 4 to 6 times revenue. On $20 million, That's 80 to 120 million below target. What they should say is something like this. We are the redemption network for Asia's loyalty economy. Every bank, every coalition, every retailer in Asia has a points program its customers don't value because the points can't buy anything anyone actually wants. We fixed that with one API. Plug in, and your points become travel on any of 50 airlines and hotels at a price we set. And we proved the demand ourselves. We built the consumer app first, deliberately, because no infrastructure company can credibly tell a bank what consumers actually want. We have 250,000 people in 2 markets who choose our currency. We know what a mile is worth to them to 1/10 of a cent, and we know exactly what it costs us to deliver because we publish it. Now the banks are coming to us. 40% of our revenue is contracted B2B and growing faster than the rest. Our consumer business isn't the business. It's the demand proof, the pricing engine, and the moat. That's an infrastructure story with a consumer flywheel attached. Infrastructure prices at 8 to 12 times revenue. On $20 million, that's 160 to 240 million. The narrative change is worth about 80 to 120 million dollars of valuation, and it is only credible if the B2B mix and the bank logos are actually real. Which is why the strategy and the story have to move together. You can't just say it. One more thing worth knowing. On my estimated cap table, the founders hold somewhere between 48 and 56% today. After a Series B at 17 to 20% dilution, they're at 38 to 46. After a Series C, low to mid-30s. Which means the Series B is very likely the last round where founder control is genuinely comfortable. That argues for a clean Series B, then a hard push to profitability, and a Series C only from a position of strength, not a mechanical ladder of A, B, C, D. And I should say plainly, acquisition is a live and entirely respectable path here. Plausible buyers include Shopback buying the currency, Ascender buying consumer demand, a bank buying the rewards layer, an OTA buying loyalty, or Built buying Asia Pacific. At $150 to $400 million for a team that raised 13.6, that is an excellent outcome. It should be run as a legitimate parallel path, not treated as a failure.